question I'm asked by a lot of people who have a small deposit, usually less than a 20% deposit, is what is mortgage insurance and why do I have to pay that? A lot of people think they have insurance enough to cover them for what they need, but mortgage insurance actually covers the bank. It doesn't cover the borrower. So in the event that something goes wrong with the loan, the bank is then covered for their risk and the mortgage insurance company will pay them back. Unfortunately though, it's the borrower who pays the premium. In the old days, people couldn't borrow unless they had 20% deposit. Now, they can borrow on as little as 5%, but the bank has to insure the loan. The mortgage insurance cost is usually added to the loan, so there's no out-of-pocket expenses as a rule of thumb, and the cost of mortgage insurance actually changes depending on how much deposit you have. So if you have a very large deposit, closer to the 20%, your mortgage insurance cost will be less. If you only have the minimum deposit of 5%, then you'll be paying maximum mortgage insurance on the top of your loan. It is a second tier of approval. The bank will always approve the loan, but then they must pass it on to mortgage insurers for their sign-off, and they're the ones that take the risk. So that can always be something that you need to consider. So that's pretty much what mortgage insurance is. If you need a quote on mortgage insurance, we cover that in great detail with our loan interviews anyway, if mortgage insurance is required. So please give us a call. Mortgage Choice over in Thomas Street in Noosa Ville.